Yields are up today. There's Taiwan semi-news we're going to get to. The dollar index, 9th straight weekly gain. I mean, you put it all in and you mix it up. What do you take out?
I think we were kind of overdue for this. Listen, in the month of September, we have not yet had a 1% move on any given day. We're sharply unchanged. So today, when you have Treasury yields, which are stubbornly high, near 16-year highs, in fact, when you see the price of oil go to $91.15, when you understand that today is not just a triple witching day, but a quadruple witching day.
The options expiration is going to be interesting at the close.
The statistics behind that, Scott, they're not good. If you go back to 1990, I think Bob gave this statistic, but you go back to 1990, the week following a September triple witching, 79% of the time the market's down, 1% on average is the loss. So bring it all together, stir it up in the pot. Yeah. It doesn't make for a good near-term formation for the market.
All that said, Jenny Harrington, the major averages for September, leading into September, like, oh, man, historically bad month for stocks. S&P's down 1% in September. Dow's flat. S&P's only 3% from its 52-week high. So we talked yesterday about the resiliency of the market. Even Ken Griffin, who was interviewed yesterday, was sort of surprised we've been able to get to where we are, even in the face of all this other stuff. What does it mean? Where do we go from here?
Well, I think with respect to thinking like, oh, September's bad, as we've talked about with the whole, like, is there going to be a recession? The more something's anticipated, the less likely it's going to actually be bad. I am firmly in the camp that I've been in for the last 2 years really now, which is we are range bound. And when I say range bound, I'm thinking of range bound at the S&P level. And that's something that you pushed me on a lot, saying like, okay, but what about beneath the surface? What about the other 493 companies? So I think at the S&P level that we're range bound. But I think if you look beneath the surface, what we've had is we've had rolling recessions. And you know what the opposite of rolling recessions is? Rolling recoveries. And so you use the word, Scott, cross currents. There are so many cross currents beneath that surface. And those cross currents create opportunity. So when you say, where do we go from here? I don't think you buy the market, but you can buy interesting things. And so in this tricky market that might be range bound, that might be kind of flat, I think you need to look for companies that have either unique growth characteristics that aren't dependent on the broader economy, that aren't dependent on the industry, but like unique to themselves. So in our portfolio, in our growth portfolio, that would be like Cisco Systems and United Rentals, or things that have unique valuation distortions.
Yeah, but I look at your move. Sorry to interrupt you, but you're doing more trimming than buying, right? You trimmed Uber and XPO.
Right, but we're fully invested.
Yeah, I know, but you're looking for opportunities perhaps to take some off the table of big winners.
Oh, for sure. Okay, fair enough.
Rather than looking to buy the market, even though you say you got to buy this, that, and the other thing. I see somebody who's trimming some winners.
Okay, but so we trimmed 2 winners, right? And we trimmed them simply because they'd grown to like large portfolio sizes and they've had really good returns and the valuations are a smidge stretch, but not enough to make us uncomfortable. And we took some of that cash and we repurposed it and added it to Ventas, which is a company that we added back in June. Ventas is a healthcare REIT. It's really undervalued. That one actually falls into that category of unique growth prospects. So as people have returned to skilled nursing homes, retirement communities, they actually really have a tailwind of rental increases ahead of them. So we've taken money off of stretched valuations, I'd say. And again, not a negative to the company, just portfolio management, and added it to where we know there's a unique growth perspective.
So, Kevin Simpson, speaking of moves, you're a buyer of some things. You bought more UPS. You bought more Walmart. I saw that sentiment number today, which was a big miss. 67.7 versus 69.2 was the estimate. I'm wondering if we're, in some respects, at an inflection point for the consumer, and if that plays anything into your buying of more Walmart.
I don't know that the inflection point's the reason for it. I think that's the thesis moving forward. If we get some economic slowdown, that the consumer benefits, Walmart benefits from the consumer dropping down. But I still think the bull narrative holds. It might be holding by a string for most of the summer. And as we head into the fall, it's September, it's October, we get a little bit nervous. But the things that have held the market up so far, the assumptions that inflation's coming down, we're experiencing a soft landing, the Fed's done or close to being done, all those themes are still in place. pace, but they become more precarious. And where I think the market might be getting it wrong, Scott, is I think we might be prematurely pricing in the rate cuts. I'm not of the camp that we're going to see them in the beginning of next year. I have a lot of reasons why, but I think we're probably looking a year out before we can really have that conversation.
But I mean, the most interesting thing you just said to me was that the bull narrative holds.
Yeah.
You think the trend is still intact?
Yeah, I do.
Why?
I just think that all of those things are still working, and until one of them isn't, then we're in trouble. So CPI was a little bit hotter, PPI was a little bit hotter, retail sales a little bit stronger, but nothing enough to move the Fed off the narrative next week. Now we'll look at the dot plots. That'll be fun if any of us care what they say. But what's problematic is that November is still going to be on the table. And that presents a problem for the higher for longer scenario to take place. Whether they raise rates or not in November, it just pushes the rate cuts back.